The Gwart Show is sponsored by Ellipsis Labs. Ellipsis Labs is building a world where mainstream finance happens on-chain. Their first product, Phoenix, is a fully on-chain limit order book DEX on Solana doing hundreds of millions of dollars in volume. I know this team personally. It's one of the strongest in the space. If you're interested in working with a team that's here to stay, Ellipsis Labs is hiring engineers passionate about DeFi to join their team. You can find Ellipsis Labs on Twitter at ellipsis_labs or head to ellipsislabs.xyz to learn more and apply. Although our guest this week is a managing partner of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. Hey guys, today we're here with none other than Kyle Samani of Multicoin Capital. Probably doesn't need much introduction, but quite happy to have him. Kyle, you just got back from Singapore, Breakpoint. What was your impression?
Hey Gwart, pleasure to be on the show. I'm very honored that I don't get to know your real name, so no special privileges here. Obviously you have a hilarious Twitter account, so when you reached out to do the podcast, I was excited to jump on. So the question was, how was Token and Breakpoint? I was in Singapore for like 10 days or something. Token, I'll start with Token because it was first. Token was bananas. I've never seen an event like that before. The website said they sold 20,000 tickets. I did not believe it when I read it. And then when I walked around Marina Bay Sands, I was like, I think they may have sold 20,000 tickets. It was crazy. There was like 2 or 3 floors of Marina Bay Sands were taken over, and it was, wild. And, like I saw for Vitalik's talk, obviously there was a few thousand chairs full. For my talk, probably half the room was full. So it was real turnout for this thing. And a lot of excitement and energy from a lot of random retail walking around. I remember I walked past the BitGet booth and I just looked in the booth just to see what was going on. And it looked like there were dozens of random retail people trying to learn about, I don't know what you learn at the BitGet booth, but they seemed genuinely eager to learn something.
We're onboarding.
Yeah. I mean, a lot of it was in Chinese or whatever, so I couldn't really understand what they were saying. But I was, these people were pretty clearly in the zone. So it was cool to see Token, and then Breakpoint, was right afterwards, and Breakpoint was super well done. I'll start with I'll do medium. Something I was disappointed with, what I expected, and then what exceeded expectations.
Nice.
What I think came in under expectations for me was announcements from large regulated financial institutions around doing stuff on mainnet, Solana mainnet. Not to say there was none. I mean, PayPal obviously had a flagship keynote talking about PYUSD. Franklin Templeton had a keynote talking about how they built natively for Solana for fund issuance of various forms. BlackRock and Securitize had a big thing talking about bridging, building the BIDL fund on Solana, and that Wormhole will be the connectivity layer so that you can fungibly transition back and forth between the two. I think there was one. SocGen had something. Yeah. Societe Generale, the French bank. There may be Citi had something. So there was a handful of those kinds of companies with product announcements. I was optimistic that there would be more. I was hoping, Stripe or Visa would come out with some strong, bold statements about some stuff, and that did not happen. So I'd say, I don't know what the market's expectations were, but I'd say based on Kyle's vantage point of the world, I was kind of hoping that you'd get more of that stuff announced. And I think part of the reason I was looking forward to that was, token extensions rolled out earlier this year. I've been fairly public that I think token extensions are going to be one of the defining features that helps Solana pull away from the pack over time. And I was hoping to see more regulated financial institutions talking about, that at Breakpoint. Where Breakpoint came in at my expectations were, what's it called? Just everyone in the ecosystem is aligned, and I mean, and I use that partially in jest about Ethereum, but everyone at Breakpoint pretty clearly feels like hey, we think we're the better ecosystem overall. And you can feel the hunger and the grit from people. And everyone's like, we see their problems, we know our strengths. We're all we're all rowing in the same direction. We don't have all these fragmented L2s and all this shit. Like we're all on Team Solana. We're here to make it happen. And that was really refreshing to see, not only from the multicoin portfolio companies, which I already kind of knew that was true for those guys, but even a bunch of portfolio companies. That was really cool to see. And then I'd say the area where things came in probably above my expectations were the quantity of product keynotes. I have not finished watching all the Breakpoint talks that I wanted to finish, but I've finished probably 2/3 of them. I've probably watched 6 hours of Breakpoint talks at 1.75x. I have probably another 2 or 3 hours to go. I have I think 15 or 20 videos left still to go. And I mean, there's been a handful of non-product things, but almost everything I'm watching is product oriented. I'll list some long tail examples of things that don't get much airtime on Twitter. One was called DeVin. It's we announced our investment in Backcess a few months ago. It's a whiskey marketplace on Solana. And DeVin is not the same idea, but I'm just going to lump it in the same category, but focused on wine. Again, the mechanics of what they do are a little bit different, and how the product works is different. I don't mean to homogenize them. But DeVin had a really good product keynote about what they're doing and how they're actually doing cool stuff with NFTs and loyalty programs for wine. Another product keynote that I really, really enjoyed was Ariel's from HiveMapper. We're investors in HiveMapper and are very publicly supportive. But Ariel, just came out very clearly, outlining not only the case for DePIN, but then the case for how they have been really disciplined about token emissions. They've, I think, deployed something like 2 or 3% of their token supply, and they've mapped more than 10 million road kilometers, which is more than 1/6 of the world's roads. And that was just awesome to see that degree of product focus. Another one I'll highlight, this is actually a competitor to one of our portfolio companies, is Zeta. Zeta is a derivatives perps. We're obviously well-known investors in Drift, and we wrote our Drift paper just a week or two before Breakpoint. And caught up with Tristan both privately and listened to his talk. And he is 100% clear, we're going to deliver basically what StarkX was actually probably the first, DYDX 3.0, not the Cosmos chain. But basically, we're going to deliver that experience even better on Solana. And I, having watched this quantity of Breakpoint talks, I'm just loving the product focus. That's really, really awesome to see.
Yeah. Okay. We'll come back to a lot of Solana stuff, but I do want to ask. So I heard you recently say you don't care about Bitcoin. You think it's, I don't know if you said worthless, but you're not a huge fan of Bitcoin.
No, nonsense.
Okay, yeah. What is the rationale behind this? Because I heard you say this, but then you said, I'm not, on another podcast, you said, I'm not here to tell you why Bitcoin's nonsense. So then I feel like I need the thesis. Why don't you like Bitcoin?
I mean, I don't believe there's any reason to own a non-productive asset. And Bitcoin is and always will be a non-productive asset. I think that's the most broad kind of intellectual reason. And then you can get into the more detailed mechanical reasons. And those would include the security budget's probably broken. I think lack of programmability will ultimately make it fall into irrelevance, because at some point the market's expectations will change as to what permissionless money should be, or I should say permissionless value creation and transfer should be. Today, the default expectation is not that it should be programmable, but that will change at some point. And when it does, I think that'll be bad for Bitcoin. Obviously, the inability to scale and looking at all these Bitcoin L2 things, it just further cements in my mind. I think the Ethereum L2s are dumb for lots of reasons, and the Bitcoin L2s are structurally even more disadvantaged, because the constraints that Bitcoin places on the L2 thingies is even like more tight than that of Ethereum. And I'm in it because like I want to support 50 billion, 100 billion on-chain transfers per day. And it's just like you're just not going to get there given the number of technical constraints that you face.
Yeah, I've heard you say though that throughout the course of history we've had basically two types of money: debt money and commodity money. So why do you think that Bitcoin couldn't be the commodity money of the digital age? You think that? So what you're saying is that they've been the two classes of money we've had in the past, and this will no longer be the case in the future. That's sort of the essence of your argument.
No, not at all. And the debt versus commodity money claim is not my claim. I mean, there's a lot of people who've been studying money and economics much longer than I have who came up with that. I'm just regurgitating their framing, although I agree with the framing and find it to be useful.
Yeah.
I'm not here to advocate debt money, which like fiat today is all debt money should replace commodity money. I'm not here to argue that at all. I think that's stupid because the social structures that make modern society work I'm generally happy with them. I'm in no way willing to say the status quo of debt money from central banks is so broken that we need to upend it and replace it with commodity money. The quantity of risk involved in I just don't understand how you can support that view just given the amount of risk that would represent to society. But then coming back to your original question of like, well, doesn't Bitcoin fulfill the commodity money vision? I mean, both ETH and obviously more pointedly Sol are strictly supersets of Bitcoin as commodity money. So even to the extent I were to hold the absolutist view about commodity money, like the answer would be Sol, not Bitcoin.
Yeah. Okay. Maybe. I would probably disagree. Like, I think the inputs to Bitcoin are commodities, right? So like that would be my rationale. It's like the inputs, energy and compute, like likely the two most coveted commodities in the modern age. That's what goes into it. So like when I think of it, I think it's like the opportunity cost of not putting those towards AI or energy production and instead going toward Bitcoin is what makes it the commodity aspect of it, right? Like obviously it has no utility as like gold or jewelry, like, so that's how I put it. We don't have to harp on this, but
lighting commodities on fire to produce Bitcoin isn't like commodity. The traditional theory of commodity money is like, well, look, like the oil is, or the oil is useful, or the silver is useful, or the gold bar, or the shells, or the cigarettes if you're in prison. I mean, like whatever. Like all of these commodities have some utility form of value, but Bitcoin and ETH and Sol do not in meat space by definition. They obviously are irrelevant in meat space. They don't even exist in meat space. And saying, well, the inputs are physical, but like who cares? Like the thing that we are calling the money is literally a database entry. So like who cares?
Okay, that's reasonable. All right, you gave a talk. Your Token 2049 talk was on Sol flipping ETH. Let's hear it.
Yeah, I mean, there's there's three parts of the presentation. One part is history of Ethereum, where I think current context. To appreciate current context, you need to understand history. And I think a lot of people in crypto tend to be young and fairly ignorant of history. So I like to recap that. And I think there's a few things that stand out to me. One, and most importantly, Ethereum is 9 years old. It launched July 2015. And like, I think people give this thing way, way, way too long of a leash. I think if this was any startup that did not have the scale of public bag bias that ETH has, like it would have died a long, long, long time ago for failing to like do what they said they were going to do. Which like the two largest versions of that would be proof of stake and scaling. And they've obviously switched to proof of stake. I don't think they have a scaling plan as of this moment. And so I think that's important because you just need to appreciate how damn old this thing is and like how long they've been like supposedly working on the problems. Second major thing I highlight is that ETH is not accruing value anymore as an asset because all the L2s are accruing all the value. And that's just unequivocally true. Like there's no debating that statement at all. And I have all the data in the presentation to substantiate that. But anyone listening to this podcast already knows that to be true. And then the third is just like ETH doesn't have a North Star. And I think that's pretty important. Every other product, I mean, even ironically, Bitcoin has more of a North Star than Ethereum. And Bitcoin's it is inert and it's digital gold. And like, I can say digital gold is dumb or whatever, but even like I, as someone who understands Bitcoin, like, and hates it, can acknowledge like the product as it exists today. And more importantly, as it has existed for like the last 10 to 15 years, is in fact oriented around the thing it claims to want to be. ETH, I don't even think has that. And so I look at this thing as like, it's worth $300 billion. And like, it's just like, that again, look, maybe it should be worth 20 billion, maybe it should be worth 200 million. I don't know. But like 300, it's one of the largest assets on the planet. It's like number 40 or thereabouts, plus or minus. And that doesn't make any sense to me. So that's part one of the presentation. Part two of the presentation is basically like kind of taking those same lenses and basically applying them to Solana. Has a North Star, a value accrual is there. And what's the third part? Oh, like there's a scaling plan and like it's iterating and getting better on that scaling plan. And then the final part of the presentation is, and then part of the Solana part is basically looking at what I consider to be the kind of most important on-chain metrics as compared to Solana to Ethereum. And it's like DEX volumes, value paid to validators via tips or priority fees or whatever. And Solana is more or less neck and neck with Ethereum on those two. Oh, sorry. It's DEX volumes, total value paid to validators, and stablecoin transfers. And on the first two, Solana and Ethereum are basically neck and neck. And on the third, Solana has come up from being, call it 1/10 of Ethereum or 1/20th of Ethereum to roughly half of Ethereum over the last 12 months. So it moving in the right direction. And then the last part of the presentation is looking ahead. And there's a few things that highlight of why I think Solana has a few structural advantages that I don't think Ethereum can replicate easily. The first is token extensions. And yes, obviously in theory, you can design the ERCs or the EIPs or whatever from the Ethereum Foundation to replicate the equivalent constructs. That's obviously possible. The problem is that like that doesn't solve the problem, because the scaling plan for Ethereum is, yeah, but all these L2s do their own thing. And all those L2s like have to agree. And the probability of getting all of them to agree to all the technical details is just going to be slow. And then you have the second problem of the bridges. All of the bridges need to be designed to deal with all of those complexities. Again, is tractable, but it requires more coordination from Wormhole, Layer 0, Axelar, or whoever else is involved in the process. So just the quantity of social coordination required to replicate token extensions across the Ethereum L1 and L2 landscape, I think is basically impossible for like social and logistical reasons, obviously not for technical reasons. Second major thing is FireDancer, which we're starting to see the kind of first public real world numbers from FireDancer as of Breakpoint. It's going to take another realistically 12 months for FireDancer to roll out like to a meaningful part of the network such that the performance numbers impact mainnet performance. But obviously like it's on mainnet now in small amounts and will grow quickly. And I highlight FireDancer because just like, I don't think there's ever been trading software written of this kind of caliber and orientation. And then the third, and this is pretty underappreciated, is like the focus on parallelism turns out to have been an even more important bet than we originally thought. We're getting more R&D dollars going into highly parallel chips because of the AI renaissance.
Yeah.
And Solana is a direct beneficiary of all of that. And again, like, could the EVM become parallel? Like, sure, Monad's working on it. But like, dude, if the original ETH research proposals for parallel EVM date back to 2016, maybe even 2015. But I remember reading them in 2016 because that's when I first got into Ethereum. And like, they haven't done it. And so it's just like, at this point, what like clearly y'all don't care about that. And meanwhile, Solana is getting hundreds of billions of dollars of upstream R&D for free that are going to help improve the system.
Interested in Bitcoin scaling, startups, or learning more about Bitcoin softworks? Join us Saturday, November 9th at the Fidelity Center in Boston, Massachusetts for Op Next, a one-day conference on scaling Bitcoin hosted by Blockspace Media, the producers of this podcast. Join Bitcoiners like Peter Todd, Portland Hodl, and more to discuss various Bitcoin proposals like OpCat, the Great Script Restoration, CTV, and more. Attend workshops, speaker sessions, and panels discussing the latest in scaling tech, from ZK to ARK to Bitcoin softwork history. And for a limited time, use code OCTOBER to get 25% off a general admission ticket. Find out more by visiting opnext.dev. Again, that's October at opnext.dev. You can find out more by checking out the show notes below.
I think the essence of it, to me, boils down to Ethereum community believes that they are more decentralized and more credibly neutral and more secure. I'm saying right now what the Ethereum community believes, right? They, as a result of this, believe that they can command a higher price for their block space. Like I really like, I look through all this stuff and I see like these different like back and forth, and it gets into the minutia. And this is really what I think it functionally comes down to is they believe there is a premium to their block space, and such a premium that they could even become merely a settlement layer, right? And both of us probably have our reservations as to whether the economics of that work at all, right? But they have such a premium to their block space, and it's so decentralized that people will in the future pay very high fees. Do you disagree on the decentralization aspect commanding a higher premium versus other newer chains? Like, is this something that you just like basically disagree with?
Yes, and this basically boils down to Tolly's claim of economic security is a meme, and which I don't think has ever been fully unpacked. So actually, like I want to unpack it here. The reason that this industry talks about such a weirdly abstract term, such as economic security, is, again, history is super important here, is because of Bitcoin and proof of work.
Yeah.
And because there is no finality in proof of work, it's always probabilistic. This notion of economic security like makes sense to reason about. And like, if it's like, look, the US is going to send some payment to China, or China's going to send some payment to the US, it's going to be a $50 billion payment or whatever, and you're going to send some ships or whatever. Like, there's going to be some sort of large transaction. And then like, can you revert that by doing some selfish mining or whatever? And so that's always been like a very fun theoretical construct to reason about. And like that is in the context of proof of work, like makes sense. And we actually had one public demonstration of this when the Binance hack in 2019 or 2020.
Yeah.
And CZ publicly tweeted, he's like, yo, miners, like, can we roll this back? It was like $40 million or something. And people did the math, and they were like, the Bitcoin miners revenue, it was like 2 weeks worth of revenue for Bitcoin miners or something like that. So like we've had one or two instances where like this actually was at least like a real thing for like even 5 seconds in the public domain. The problem is none of that shit matters at all when you're in a system with proof of stake and fast finality. And so let's be more concrete about that. Solana blocks are finalizing on a rolling basis roughly every 400 milliseconds. Maybe if you want to round up and call it 1 second, call it 1 second. But like on a rolling basis, there, whether it's again 2 seconds from the prior, it may be 2 seconds from the, or even 8 seconds, doesn't matter, from the slot till now. But on a rolling basis, it's roughly every 400 milliseconds. And most of the major chains, Sui and Aptos and Say and all these things are like, I'll call it 1 second plus or minus. If you are accepting a payment, whether that payment it requires delivery of physical good, let's just call it a house, or even better yet, let's call it a car, because then you can like drive away in a car. You can't drive away in real estate. Or that payment is to a centralized exchange that is interfacing with fiat systems. So let's say Circle or Coinbase or Binance. If anything happens in which blocks stop finalizing on a rolling 400 millisecond basis or a rolling 1 second basis, then like you are not going to credit the account of the person who just sent you the money. But by definition, because every single one of these entities, whether you're again the person selling the car or whether you're Coinbase, Binance, or Circle, you are not going to fulfill your side of the deal until you see that the transaction is finalized. And so it's like, okay, the transactions aren't, like, assume now it's a worst case scenario, transactions aren't finalizing for whatever reason. Like, okay, fine, I'm not going to honor this. And so like the opportunity for malicious intent, like in the context of theft, basically doesn't work. Now you could say, well, it's someone's job to cause havoc and they have a massive short on. And like, yeah, it's possible. The problem is like, again, no one has demonstrated an ability to do that. And at this point, like with both Sol and with ETH, the markets are so liquid and so large that it's becoming basically infeasible to do that. And then the other obviously part of this is like, assume like a weird scenario and someone like acquires enough Sol and runs enough validators at home. Well, like the beauty of proof of stake is that all faults are attributable. And so like in the event that you can detect people doing the like Vitalik and even Eric Wall and a bunch of people have really good blog posts from like the 2019-18 era on the primary benefit of proof of stake over proof of work is attributability of faults to a public key. And so you can just see like who's acting poorly. And in certain instances, you can actually outright slash them, like double signing being the most egregious. And so, yeah, I just like coming back to the original point. It's like when we talk about economic security, like there's a base level of it of like, hey, look, it shouldn't be trivial for someone to come and like screw up consensus. But like at the scale of Sol today or ETH today as assets, I don't really like going from whatever. Solana has like I think 50 billion staked plus or minus. With let's just say daily liquidity on the Sol asset, let's just say it's 5 billion. I think that's a good lower bound. And versus ETH has got say probably actually only 100 billion of staked. I think a third of ETH is staked, something like that.
Yeah.
And let's say liquidity on ETH is let's just say it's 50 billion. Let's just give it 10x to Sol. Like I don't really understand what attack vector is like that you're mitigating against, given the reality that any rational market participant who is relying on these systems to do some sort of business transaction, like their behavior will change when the blocks stop finalizing. Because again, like that's the second part of this that matters. Circle's not just going to get robbed. They're not going to just start sending fucking wires out the door on the other side, like if the blocks don't finalize. And so I've Totally statement is obviously a little bit disingenuous and it's a little bit hyperbolic because it's not a meme. I don't mean that in the literal sense, but I think the value of economic security in the context of a large scale proof of stake system with fast finality is like it's logarithmic, and like where X would be like the amount of quantity staked and Y would be economic security you're getting. It's definitively logarithmic in scale, and so I just don't know what you're getting.
Yeah. Okay. I would probably agree. Let's talk about how chain should be valued on MEV. You've talked a lot about this now already, but I'm actually curious to know when you value Sol on its MEV, is your assumption that like, I don't know, 10 years out, but maybe however long time frame you have thought about this, is your assumption that the nominal amount of MEV goes up, but the percentage goes down? Like basically, is there...
Yes.
Yes? Okay. What do you think? So I think, speaking of like a little bit, not disingenuous, but maybe incendiary, I think your argument that chain should be valued on MEV is a little bit intentionally incendiary, because I think you're trying to prove a point, which it's like it's a bit of a troll in the same way that totally trolls about Chihuahua chain and economic security and USD, like wormhole, like all of these things are like quite similar. But my larger point, which I wanted to ask then is, okay, so you model the marginal cost of software at zero in proof of stake systems. I would say yes. What then is a reasonable equilibrium for amount of MEV extracted in the long run? Like, I don't know, percentage wise, like how do you actually think about like looking at how much MEV can be extracted? And then also you have talked about apps. Like, do you think they'll take 70%, 30%? Like it's some type of split. I'm curious what your thoughts are, like long run, how much MEV is being extracted?
Yeah, I believe the percentage of MEV flowing to L1 validators or stakers versus apps today is approximately 100% to validator stakers. Maybe if it's not 100, it's north of 90 for sure. And I expect that percentage will go down substantially. My base case is like 25% to L1 and 75% elsewhere. I'll walk through kind of a few illustrative examples to break that out. The most important form of MEV is order flow auctions, because that represents an organic, like real user clicking buttons on a screen expressing intents to do a financial transaction. And like these are financial systems, like that's what people should be doing with them. And in order flow auctions, you can internalize to some combination of the maker, the taker, the wallet, or whatever, the broker, whatever you want to call it, and the validator, and the searcher. Those are like the 5 parties who are today somehow divvying up the MEV. Today, the bulk of it's going, or at least the substantial percentage of it is going to searchers, and then the balance via priority fees to stakers and validators. My guess is that the amount going to validators and stakers does not go to zero, because you need to pay the validators and stakers some amount to play ball. Nitesh from Deflow has some more refined thoughts on this, and I won't explain all of his reasoning. We're an investor in Deflow, so I get to have a lot of conversations with him about this stuff. But my base case is that I believe order flow auctions are the single largest source of MEV, or I should say, I don't know if they are today. They, without question, they will be in future states of the world. And my bet is that about 25% of that MEV will flow to stakers and validators, and 75% will be either rebated to takers or to makers. And I think searchers will be cut out entirely. Searchers are strictly leeches, and obviously all of the other parties in the system are incentivized to screw the searchers. Searchers are only winning because of just the very naive system designs that we have today. And like they can obviously be excluded via mechanisms that are not very difficult to understand. So that's one illustrative case. The next illustrative case I would highlight is anything that is managing collateral. So any system that offers leverage, whether it's Aave or Camino, or whether it's Drift or like the Perps exchange or whatever. In any of those systems, obviously, like you don't even need application specific ordering, like the app, which is a very stupid concept. But like to enforce MEV capture to the app for any of those systems, you just need to update the contract. And it's whenever there's a liquidation or some other thing happening that currently today's searchers are profiting, you can just like write in the contract and just say, well, whenever you submit that liquidation transaction, like part of the revenue just goes back to the DAO. Like it's trivial to write that logic. I think Aave is actually doing this now, if I'm not mistaken, for some percentage of their liquidations. I could be wrong. I think there are a handful of instances in which this is happening today. Obviously, we'll scale up a lot in the coming years. And again, like in those cases, my base case is probably something like 80 to 90% of the revenue gets internalized to the app, and 10 to 20% goes to the validator. Because again, assuming those mechanisms are designed to be permissionless, then like there will be multiple people vying to get that balance of the MEV. And so of that 10 to 20% that remains, some fraction will go to the searcher, some fraction will go to the validator. And again, I generally think validator, in any case in which you're pitting searchers against validators, I think validators obviously have the structural edge because they're the ones that make all of the fucking final decisions. Searchers are mercenaries. The validators get to do whatever they want. And then I think the third kind of example that I think is super important is SexDex ARBs, which I explicitly define as not an app. I think it's incorrect to model those as apps. And SexDex ARBs obviously will always exist, and they'll be very variable and all over the place. And again, in those instances, some percentage will go to searchers, some percentage will go to validators. I generally don't understand how searchers can take more than roughly 20%, because validators get to choose what they want to accept. And obviously, the more sophisticated searchers become over time, the more competitive searchers become, which just means they drive searcher profitability down and therefore validator profitability up. Like those two things must be directly inversely correlated.
When you see Toli and Sriram going back and forth about the feasibility of NASDAQ on chain, do you think this is possible?
I mean, literally to offer whatever NASDAQ today offers in terms of price and performance, no. But it's like a North Star, and it, like obviously is being interpreted too literally to like give yourself brownie points for like winning a semantic argument, which is just fucking stupid. NASDAQ also doesn't offer fucking what Drift does, which is have margin collateral management on chain that's composable with a borrow lend market that lets you use arbitrary forms of collateral to fucking go tradition. So like what we have, my point is what we have on chain is already a superset of NASDAQ in terms of just like strictly financial functionality, not just spot limit orders.
What assets do you think we are trading on Solana in 5 years? Because like you've noted sort of with USDC, for example, it does matter the nature of the asset, right? Like if these are ultimately, if their property rights, let's say, are enforced off chain, we may have a different necessity for censorship resistant, qualities or whatever, right? Like what you were talking about sort of before. What do you think we're trading on chain? Are we like, is equities on chain the North Star to you? Like, what are the actual assets? Because I do think, like, when I look at this, obviously it does make a difference in my mind. And I also think, side note, I don't think Citadel is coming on chain if they're going to get Jared from Subway, unless they are Jared from Subway, like Jane Street and Manta, So like that does make a difference in my mind in terms of like the long-term trajectory. What do you think we are trading on chain?
Multicoin is our 7th birthday is tomorrow. Well, I guess by the time this podcast, thank you. This podcast drops a little bit in the past, but our 7th birthday is October 1st. And I've obviously been reflecting a lot in the last 2 months. Been doing this for 7 years of my life. What has gone according to plan, what has not. And the thing in which I was way, way too aggressive in forecasting was time to get efficiency in the capital market structure.
Yeah.
And you should interpret that statement extremely broadly and in like almost every possible respect, from at all time scales, from venture to HFT and everything in between. And so I provide that context to answer your question, looking forward in 5 years, to say, I think in 5 years' time, we have a meaningful amount of regulated traditional assets on chain. Meaningful here, not meaning like, 10% of NASDAQ is now trading on Solana. Or that's not the correct interpretation. It'll probably be single-digit percentages of volume that trades on NASDAQ trading on chain. Whether it's 1 or 4 or 7, no ability to reason, but like I think it's north of 1% and definitely less than 10%. And like this is how you're opening up access to people in long tail markets to access all of this stuff. And obviously in both custodial context, whether it's going through Nubank or Revolut or whatever else, or whether it's through DeFi wallets and stuff. And obviously those two statements are not mutually exclusive, meaning like there's a world you could see in which Robinhood issues, like they get the licenses and they issue Apple stock or Google stock on chain, and then like random guy with DeFi India wallet for DeFi in India like is trading those things. So the permutations of this can be very weird. But anyways, single digit percentages on chain in 5 years. I think it's going to take the world in which DTCC as it stands today is, I think DTCC is actually like the kind of the core of capturing TradFi. It's not NASDAQ.
Yeah.
DTCC probably is legislated away probably in 15 to 20 years. I think it's high confidence more than a decade.
Okay.
Where beyond 10 years, harder to know.
Yeah. Okay. That's reasonable. All right. Let me ask you then, where is Ethereum headed? You have this strong thesis that Sol is going to flip ETH. What does the next 5 years look like for Ethereum in your mind?
Peace and then chaos. Peace because the Ethereum Foundation, I believe, is incapable of transitioning into wartime. I use the terms peace and wartime, not as terms I'm making up right now. Direct reference to Ben Horowitz's book, The Hard Thing About Hard Things. That chapter was probably the most important chapter of any book I've ever read, or at least in the context of entrepreneurship and business, because it gave me a frame to understand small startups versus big companies. And the Ethereum Foundation was at one point in wartime. Most obviously, like the first 12 to 24 months, like leading up to network launch. They famously raised their ICO in Bitcoin. They kept it in Bitcoin. The price of Bitcoin was going down. They were running out of money. Like they barely launched this thing. There was a ton of team fighting and internal fighting. Like Charles left and Gavin ended up leaving later. Like that history is very well documented. And there were a lot of ways in which Ethereum could have failed and in which Vitalik and the other kind of core folks who were around at the time, whether they knew it or not, were operating in war mode, because they had to get this damn thing out.
Yeah.
And at some point, my guess is 3 to 6 months after the DAO hard fork, they transitioned into peacetime, again without knowing it, and have obviously not come back to. Clearly, they're not in wartime today. And I'd say approximately January 1st, 2017 is probably a reasonable, if you had to draw a line in the sand date. Oh, sorry, January 1st, 2017. It would be a reasonable date to choose based on my understanding of history through this lens. I think at this point, the EF is structurally incapable of transitioning back to wartime, as a function of the inertia of the organization and the culture of the organization. I say all of that not based on my direct interfaces with the Ethereum Foundation, because no one there will ever call me or talk to me for obvious reasons. Although if they did call me, I would answer the phone. And then also secondarily, because I think Vitalik is just like incapable of a person of like being in war mode. It just, and war mode explicitly requires the leader to acknowledge that they were in peacetime and to explicitly tell everyone in the organization that we are now in wartime. And I just don't think that he is capable, and given the inertia of the system, is not possible. So the original question was, what happens to ETH over the next 5 years? And I said peacetime and then chaos. And so that ramble was substantiating the first part of my claim, which is they're not transitioning to wartime, and so therefore it will be peacetime. And it will be peacetime up until the point at which Sol is roughly flipping ETH. Whether that happens in 3 months or 9 months or 18 months or 36 months, I don't know. I think it will happen with a very high degree of probability. And as you know, leading up into it, and then obviously shortly thereafter, everything degenerates into pure chaos. Because once the consensus becomes Sol flips ETH, which obviously is not consensus today, both as a function of market cap and as a function of like public sentiment and discourse. But like once the latter flips, when the general consensus view of the median capital market participant is that Sol will flip ETH, then everything transitions into chaos, and it falls apart very quickly.
Okay, what do you think about this theory? When ETH transitioned to proof of stake, they reduced the cost of computation by 99%. This feeds into your thesis that the marginal cost of software is zero. I think that the ultrasound money idea is maybe one of the only ways, in fact, to induce holding of ETH and potentially capture value in terms of forcing forced holders through staking. Like I look back, so I think the reason I'm saying this is because you reject the entire ETH is money idea, which I don't think is
and also Bitcoin is money too. Yes.
Okay, that's fine. but the ETH, okay, so the ETH is money idea you reject. But here's my thing. When you transition to proof of stake, ETH, it was trading at, I don't know, whatever, 3,500, 4,000, right around the merge. I forget how much we're trading at.
It was September of 2022. It was probably around the current price, actually.
Okay, so, but here's the thing. How do you maintain that value when it, in theory, should converge on its utility value, right? If you've now reduced the price of computation by a substantial amount, how do you keep that monetary premium? I mean, the irony is that like ETH, they talk about the monetary premium, right? ETH is already trading at a 10x monetary premium. So I look at this and I say, this was actually a good attempt. We'll see if it works out, but it may have actually been a way, because now it's the cost of software, which you argue is zero. Do you think that this, I mean, and also I'm kind of curious, like what you think of long-term, like how Sol deals with this same idea. And I think your answer is MEV, but I'm just interested if you think that maybe the ultrasound money thesis was a good idea to imbue this idea of a store of value.
A lot of the history of Ethereum is rooted in Bitcoin.
Yeah.
And that statement is also both obvious and underappreciated. It's obvious in that, like, if you go look at all of the early ETH stuff, like pre-network launch, it was like there was proof of work mining. They were talking about what's it called? They talked about merge mining, and they were talking about what's it called? What was the thing for Uncle Blocks? And they would reward you for Uncle Blocks, and whatever. Merkle trees and verifying the blocks and light nodes, and obviously a very strong focus on monetary policy. And I say all of that because like Ethereum from inception like was modeled after Bitcoin, and like Ethereum V1 was Bitcoin with Solidity, like more or less. Obviously with its transition since then, but like that's what V1 was. And my observation has been, sorry, I forgot the most important part of this. Like at-home validation was obviously very deeply ingrained in Bitcoin and continues to this day to be ingrained in Ethereum, although you're starting to see a lot of people kind of publicly question that. So I think ETH has always somewhat explicitly and then somewhat implicitly like wanted to be money. And like a lot of the people who were attracted to ETH, whether they joined in 2014 or whether they joined in 2019, I think have all had some of those money undercurrents as a function of the path, of the history of Ethereum and like when and how they got into it and what they read about Ethereum in the months of those people getting involved leading into it. Solana is the opposite of that. Anatoly has been very clear that he like, I don't give a shit about any of this stuff. I'm here to build decentralized NASDAQ. And so your question was like, was ultrasound money a good idea or not to promote as a meme? I'm not sure it was even like a question of a thing that they should promote. It just seemed like inevitable that they would promote it, given the history. I think Justin Drake kind of formalized it with the term of ultrasound money. But I think it was kind of preordained, basically, that like again, absent a wartime leader saying, "Hey, JK guys, new plan." That was basically the plan they set themselves to be on in 2014. Is the general idea of calling yourself ultrasound money a good idea or not, or for that matter, any form of money? I would say the answer is no, because I think it is counterintuitively. Calling your thing money should imply it's the largest TAM in the world. And I think actually the exact opposite happens in practice, which is like you're to upend the social structures to become money that is so catastrophic to society at large that you basically prevent it from becoming the case because you do not get large scale social acceptance. And the reality is that like, dude, 90%, maybe 99% of people are docile. And if the government tells them something is illegal, they will listen. And so directly attacking governments by calling your thing censorship resistant money or world's better money or whatever, I think implicitly limits your TAM as a function of social acceptance.
Okay, so I wanted to touch on, you mentioned earlier Deflow, an investment you guys have made recently. Can you give us like a breakdown of that and also maybe some of your overarching thoughts on order flow and wallets in general?
Yeah. So Deflow has partially announced kind of their plan, but not the entirety of it. So I'm somewhat limited in what I can say. But I'll kind of describe how really Nitesh, the founder of Deflow, is the one who has informed how we think about order flow markets, and our belief is that his assessment is kind of the first order correct one. And Nitesh's worldview, or I should say Deflow's, is that their objective is to get to be able to segment toxic and non-toxic flow in a permissionless way. Today, this is happening on Ethereum to some extent, but it's strictly permissioned. Uniswap X kind of being the flagship example. And obviously Uniswap X just completely controls the order flow auctions. And Nitesh came up with a mechanism to make that process 100% open source, 100% permissionless, and to operate on chain, which sounds kind of impossible for most people who have thrown their brain at the problem, but he figured it out. What I can say about how he figured it out is that it is a full stack solution, meaning you need to have you need to have a validator sidecar running. So you need to be able to change how that works, like MEV Boost or any of the other things that Flashbots has put out, or Jito. Obviously, the nature of the sidecar here is substantially different, but you're going to need to do that. And then you need to obviously interface with sources of order flow. And so when you kind of approach this problem in what I would call a full stack methodology, then you can actually segment order flow in a permissionless way on chain. And then if the order flow is in fact segmented, then that means you can actually have different prices for segmented versus non-segmented, for toxic versus non-toxic order flow. This strikes us as like the first order correct approach. And let me substantiate that claim: first order correct, or first principles correct. I think payment for order flow is awesome. It obviously sounds evil. And I think 99% of people, when they hear about payment for order flow, think it's evil. And I understand why they think it's evil. But payment for order flow is a weirdly socialistic, like it looks like it's socialism, because what happens in practice is retail gets better prices and Goldman Sachs and Bridgewater get worse prices. And like, I would actually argue that the free market theory would say, no, everyone gets the same price. But actually because of how NBBO works and the fact that spreads are wider, it allows Citadel and Jane Street and Jump and Virtu to quote tighter on Robinhood than they can on NASDAQ or NYSE. And there's plenty written about that. For those that are unfamiliar with all of this, because I skipped over a lot of steps in that last 45 seconds. Matt Levine of Bloomberg has written the quintessential blog post on understanding why PFOF is good for retail. I'll share it with you, Gwart, if you want to share it with the audience in the show notes. So anyways, the Deflow perspective comes from the belief that PFOF is good, and that if your goal is to serve retail, meaning random Joe Schmo who's probably not KYC'd, or even if they are KYC'd, they're clearly not Multicoin or not Goldman Sachs or not Bridgewater, then you can in fact give them better prices via segmentation. We obviously have enormous amounts of empirical proof that is doable in TradFi markets. The challenge in crypto has been there's been no way to mechanically implement that while still maintaining the ethos of crypto in terms of like 100% open, 100% permissionless. And the Deflow team believes they have cracked that part.
This is happening on Ethereum now as well. A little bit more behind the scenes, I would say, but it's definitely happening, at least with the wallet origination side. But I am curious, do you have reservations about some of this may be inevitable regardless, right? But do you have reservations about this being a centralizing force, especially when it comes to kind of like the verticalization of order flow directly to validators? I don't know if you have thoughts, if this is something that looks centralizing in the long run, if you get a lot of, sort of economies of scale with this type of vertical.
I'm not. Can you please describe the specific vector of centralization you're envisioning here?
So I guess an extreme example would be a wallet has so maybe a wallet has a deal with a builder. Okay, let's say that the builder has a deal with validators. The validators decide that, wait, we can be the builders. And in a scenario where, and you were talking about this before, about how searchers are probably going to be thrown out the window, which I think I also agree. We already see this with vertically integrated searcher builders on Ethereum. I think that this is something where it can pretty quickly, I don't know, maybe not quickly, but over time, this can have the effect where validators are sort of have a direct line, and they can build they can monopolize this area of direct from retail to validators. And you're right, they may be getting better execution, but these validators grow as a result of that. And there can be centralization, right? In that domain. So I don't know. I guess there's potential centralization along different parts of that, but I guess the extreme case would be validators start developing monopolies because they have or like order flow directly from retail?
Right. So I want to address your thought both specifically and then also zoom out generically, because you touched on something that I think is super important and underappreciated in these crypto systems generally. You want to have validators. I mean, look, you have like 5-ish parties at play. You have takers, makers, searchers, validators. I guess that's it. Right. I mean, okay, yeah. Let's just say there's 4 parties for simplicity here, and searchers are leeches, obviously, and like I'm fine calling them just basically evil for the purposes of this discussion. Although I don't believe they're evil people, but like in the context of MEV, like, don't hate the player, hate the game. So to be clear, so they should be taken to 0. Again, I like using 50 bips here. It's the default spread on most UI. Like Jupiter defaults to 50. I think Uniswap defaults to 50-ish. So it's a reasonable kind of illustrated place to start from. If you're going to get to a world in which you're going to rebate that 50 bips back, you're rebating it back somehow to some combination of maker, taker, and validator. And we can't know what the split will be today. Then there will be some market dynamics around it. I think it is reasonable to assume that validators get a reasonable chunk of it. Is reasonable mean 20 or 40%? I'm not really sure. I don't think validators are going to want to play ball if it's less than 20%, is kind of my gut. And if it's over 50%, my gut is makers and takers are not going to play ball. So I think that the generically way to think about it is a third. And I think probably, obviously takers here are not constituents in it, like, but the wallets are representing the takers. So I'm using the wallet as the proxy for the takers. And obviously, and by the way, the wallet can take part of that taker rebate to themselves underneath. And my guess is you end up probably not a third on the nose, but you end up 5 to 8 points off a third. This is kind of my rough guess of where you net out there, because you need all parties to play ball. And I can tell you what Deflow is doing is it recognizes this and it allows kind of the market mechanism to figure it out. So I think that was part answer to your question about like centralization risk. The other part of this is I want to zoom out. I've heard for many years about centralization risks in the design of Solana. And it started with the most obvious one, which was like hardware requirements. And then it got into like the stake distribution. And it was like, oh, well, Ethereum started proof of work. And the 7 years of proof of work was so good because it distributed the stake. And, obviously proof of stake is centralizing because like if you just take your coins, then like clearly you're, getting more coins. And then like if you listen to Justin Drake and Anatoly talking about like timing games and all that shit. And like, and what I've kind of realized is you can sit here in an academic vantage point and like you can very precisely pick apart elements of these systems and you can very objectively describe these different kinds of vectors of centralization. And my read of Ethereum is that whenever some academic finds one of these vectors, it like becomes the priority to figure out how to design it out of the system. And the mechanisms of doing so have become increasingly complex. And like, I genuinely today can no longer describe like the entirety of the Ethereum plan. There are obviously some people who can, but I think at this point it's a fairly small group, like probably on the order of a couple hundred people who like really know everything kind of going on between PBS and the relays and the private order flows and the roll-up roadmap and then the interoperability between the roll-ups. And there's just like the DA and then the different DA mechanisms. And right, there's just a lot happening here. So anyways, my point was that these academics have increasingly layered on more ideas of like how to mitigate whatever vector of centralization that you can identify. And I kind of just have come to the conclusion that like they're just optimizing for the wrong things, because every criticism of a centralizing vector in Solana like was objectively correct. I don't dispute any of them. And yet the Solana system as a whole is just like objectively way more decentralized today in every way that you can imagine over the last 6 years. Like it's just like not even, or 4 years rather, 4.5 years. That's how long mainnet's been live. And so I've just kind of realized, I'm like, what are you doing? And then if you kind of will go from there and you say, well, why is that empirically the case when you can identify these academic vectors that would suggest otherwise? And I think the answer, in very crudely, is just more people and more market cap. And like for more market cap, the answer is, hey, the price has gone up a lot. You owned a lot. You were staking a lot. You've accrued more. As a percentage of your net worth, Solana has become too high. And so like you sell because it's become too high. And like every rational person, not every, 99.9% of people will do that at some threshold. And given that Solana's up to something like 3,000 or 4,000x from 2,000x from 3,000x from where the first thing traded, I'm fairly confident saying 999 out of 1,000 people have meaningfully de-risked. I will put myself in the 0.1% there. And then the second part of that is just like the more people who are involved, which is obviously like kind of intrinsically a corollary to the market cap one, because as those people sell, new people show up and buy. Those people are bag holders. They want to be involved in the ecosystem, and they show up and they do stuff. And they build apps and they build dev tooling and they build fucking new stable coins and whatever they're doing. And like, it just becomes more decentralized. Like that is the definition of becoming more decentralized. And it's just become like so clear to me that the vector that matters is the people showing up to do stuff. The hard part is when too many people show up to do stuff, you just need to make sure everyone keeps rowing in the same direction. And that's where that's the difference between Ethereum and Solana. In Ethereum, objectively, everyone's not rowing in the same direction. And in Solana, there's starting to be some fragmentation. It's by no means perfect, but to a much larger extent, everyone is rowing in the same direction.
What do you think, quickly, like partially related to that, what do you think of some of the SVM teams now building Ethereum, I don't know if I'm going to use the correct terminology, L2s or rollups or sidechains or whatever it may be? What are your thoughts on that?
I'm always in favor of experimentation. So like, go have fun. I don't like it. I want everything to happen on Solana mainnet. Doesn't mean I'm going to try and stop it from happening elsewhere. Look, I think Hyperliquid is like the interesting case study here of go full stack, perp dex, and L1 basically. And the question is, does their latency advantages from being centralized, are they sufficient to get to escape velocity for a more generalized ecosystem? And obviously the other side of that, in the case of Solana, is that there's actually two theoretical counters. One is with some combination of fire dancer and improvements to Agave plus Double Zero, which is the new internet private fiber thing. Can you like, how much can you reduce the discrepancy between Solana today and Hyperliquid today? Or I should say Solana tomorrow with those things versus Hyperliquid. And then the other point would be just like, well, hey, I just fucking build what Zeta's doing, which Zeta is basically StarkX. It's DYDX version 3, 2.0, but built on Solana instead of built on StarkX. And so kind of both of those experiments are being run as the countervailing experiment to Hyperliquid. I'm generally of the view that like below some threshold of latency, it doesn't really matter. My sense is that threshold is somewhere between 500 milliseconds and 1 second. Obviously, there are people who will want lower latency, and I don't mean makers. I mean like organic takers, just like people who are punting around. And there are some people who want that, and I understand why they want that. I'm not saying their preferences are like wrong, but I think that that's like 1 or 2% of users. I don't think it's a meaningful percentage of users who care. So I've just generally never been of the view that like that is the vector of differentiation that matters in the long term, but I could be wrong. Coming back to your original question of like SVM sidechains or SVM rollups or whatever, people are going to do lots of stuff. What Zeta's doing is interesting. Is basically like it's hyper liquid on Solana is like I would call it that, not architecturally, but like in terms of ethos. And then like all the gaming stuff, so Magic Block and Sonic, we still have no idea what PMF looks like for games. To the extent you do have 5,000, 10,000, 20,000 TPS of some game with whatever 5 million DAUs. Forget about 500 million DAUs, but even like 5 million DAUs in some sort of MMO or something. We don't know what that game looks like. And so like, yes, if that game exists and does in fact need that kind of TPS, there's zero chance it's going to go on Solana mainnet. And so, like it needs to go somewhere else. And in that case, I hope it ends up a Magic Block or Sonic instead of a full-blown sidechain. But like, we still don't know what that game is. And like literally absolutely no one on the earth knows what that game looks like today. And we're what? Somewhere between $2 and $5 billion, not of money raised, but of money spent by gaming teams over the last 3 or 4 years. Some probabilities are decreasing here, and then the third part of that you didn't actually ask, but I'll kind of address anyways, is just the stuff that like looks different, and I think Grass is probably the best example of that. They called their new thing a data L2 at first, which I think was very confusing, because that doesn't mean anything, and like it is not like a stateful system for moving assets around at all. So it like very objectively is not an L2 at all. And stuff like that, I'm like very supportive of. Like, hey, like you need some integrity properties that like ties back to the chain. I get it. Like, cool, go for it. ZK compression falls in this bucket as well. Again, like very supportive of these kinds of things. That they need to do something around data integrity that like you're not going to put it all on chain. Those things I think are fantastic.
I haven't really asked you yet about DePIN. And I know you're a big supporter. Grass is like a DePIN project, kind of, right? Is it one where you like
in more than a DePIN, but yes.
Is this the thing where you like let your computer idle and it gives you rewards?
Yeah,
I'm not using the right terminology, but
specifically, Grass is an IP proxy network would be the more technical term.
Okay.
And so like you're just giving you're basically giving your IP address for rent. Okay. For someone else to come do something. That something is almost always some form of scraping. The amount of data typically that you are going to relay on behalf of a requester is fairly small, probably like on the order of kilobytes or megabytes, not a large amount of absolute data. What matters more is geographic distribution of IP addresses as opposed to quantity of data.
Interesting. Okay, so then I guess adjacently related, DePIN in general, like you seem quite bullish on the premise of sort of tying real world work to capital formation. I don't know, you can give your spiel. Tell me what excites you about this. I've obviously seen a lot on Twitter as of late, so but I'm really not knowledgeable, and I'm like being truthful about that. I don't really have a preconception, so you can give me the full sell here.
I mean, so there's lots of things calling themselves DePINs now because it's a buzzword that are not DePINs. I think in the purest sense of the word DePIN, to me, there's like two major elements of that. One is the P, which is the physical part, and that means that excludes most things that call themselves DePINs, but that means the things that are DePINs would most obviously be Helium and Hivemapper, because like you're buying a physical WeatherXM demo would also fit in this bucket. You're buying a physical widget. You are doing something in the real, whether that something is providing a service or whether that something is capturing data of some form, but you are doing something in meat space. that something is also in almost all cases GPS sensitive. And there's different degrees of GPS sensitivity. Hivemapper cares about this street versus the next street over. Helium, you care every 500 feet or whatever. So like there's different degrees of sensitivity to GPS. Demo cares is far less granular in GPS sensitivity than that, or WeatherXM. But there's a physical component, and the second part, and this is the part that I believe is the more crucial part, and that's far less discussed, is the specific element of the capital formation, which explicitly is a like a WAGMI, like we're all in it together kind of a thing, or we're all going to will it into existence, which is, look, like Hivemapper or Helium are very instructive here. If one person buys a Hivemapper dashcam, and only one person ever buys a Hivemapper dashcam, obviously the system as a whole does not work, because like one person is not driving enough. Google has more cars than one. Let's just say Google, for simplicity, has, I don't know, 500 cars. It kind of sounds right. I don't think they have 5,000 cars. And so like for Hivemapper to work, you probably want to say you need like 100x what Google has, like as like a lower bound. I think is like a reasonable thing to believe. So let's just say it's 500. That means you want to have, 50,000. I think Hivemapper today, by the way, is at 50,000 plus or minus dash cams. And so, like person number one who buys it, great, doesn't matter. That person's taking on a lot of risk though, because you need 49,999 more people to show up. Obviously, no one knows the exact threshold ahead of time, which also introduces a further degree of risk to this risk calculation. But let's just assume it's knowable ahead of time for simplicity. Like person number 50 is taking on less risk than person number one, but still taking on a ton of risk. Person number 49,000 is really not taking on much risk. And obviously person number 74,000 is taking on kind of zero risk as it pertains to this very simple reasoning. And so the beauty of DePIN is that you have self-selection, because person number one, in terms of like their interest in mapping, is like very clearly different than person number 74,000, which is very clearly different than person number 750,000. And so there's a beauty, like there's a beauty here of self-selection. There's a beauty here of like that, at least the early people, I can feel like pretty confidently say the first 5,000 people who buy any of these widgets, like almost all cases, like they don't even care about the money.
Yeah, they're like hobbyists.
They just think it's fucking cool.
Yeah.
And then those people get a lot of upside. And then increasingly the people doing the work the base of those people shifts from missionary to mercenary as the collective market comes to believe the probability of achieving objective becomes more and more real. And then the amount of return should be decreasing approximately commensurately with that. And like that's the beauty of DePIN, is that like you facilitate this large scale capital formation, and you have a risk reward element to it, and that is incredibly important. And that's what I love about DePIN, and the hardware based networks capture that the most. The problem with the software based ones, so like all of the DePINs, is that it's just like trivial to like run software on a computer. So the Sybil's increase dramatically. The degree of like devotion and caring from the people decreases dramatically. So it's just like fundamentally the self-selection effect is still there, but the pronounced effect of it is substantially reduced.
But I wanted to come back sort of full circle now to where we started. You gave this talk in Singapore that Sol is going to flip ETH. What do you think is a reasonable valuation? So Sol's currently trading at $68-70 billion. Ethereum is trading around $300 billion. This is from 30 minutes ago. But my question is like, what is a reasonable valuation for these two? And like, where do you see this flippening of Ethereum by Sol? Like, what number do you see this around? Because like, the reason I ask maybe is like, ironically, Ethereum could lose 75% of its market value, and then Sol could flip it. You know what I mean? So like, this is why I'm kind of wondering if where do you see this threshold maybe?
Yeah, no views on how much Sol goes up versus ETH goes down. And obviously those two variables are theoretically independent. And in practice, like there is some inverse correlation because like some of the money leaving ETH will be going into Sol. It's not going to like go to dollars and like not come back to Sol. Not all of it anyways. So like I have no view. Is the answer is somewhere between 70 and 300. Like that's not really telling you anything. No particular view. I'd say the thing I have more of a view on is kind of what I said earlier, like the peacetime and then chaos, where I think it's like no one's really paying attention, and then as it gets closer to happening, it like the rate of flippening happening accelerates as you get closer to the moment.
I was hoping you would give some terminal value for Solana, but
it's really hard. Actually, it's funny you say that. So like my CFO like pinged me yesterday, Brian, and was like asking me, we had a discussion about this in IC fairly recently. And he's like, look, man, I don't know about how much MEV is going to go to Sol or is going to go to Deflow or is going to go to whatever, Pith or Jito or whatever. He's like, I don't know, man. I was like YOLO along Facebook because I just understood that everyone used it. And I didn't really think about the monetization. And I just was like, I knew everyone fucking used it. And he's like, tell me why that's wrong. And the first thing I told him was no reason by analogy. And then the second thing I told him was, if you wanted to try and apply that system here, the risk factor would be, we didn't know in 2012 when Facebook IPO'd how well native ad units would monetize. And like that was actually the number one risk factor at the time of the IPO, was like they had almost no advertising on mobile. Like all the advertising was on the desktop. And it seems obvious to us now of like, oh, you're going to scroll the feed and there's going to be a native ad unit in the middle of the feed. It's going to take up the whole fucking screen. I don't even think stories was I think Snapchat hadn't even launched stories yet.
Yeah.
So you only had like the vertical feed, not the horizontal stories full screen feed. And so, you know, people were thinking like, how do you apply the ad on the side of the screen to like the 5-inch screen? At that time, screens were 4 inches. They weren't even 6 inches like they are now. And it was like, I don't know how much money are these guys going to make. Is mobile going to kill their ad business? And so like the question was, how much are the ad units going to monetize in mobile? And I think I would even guess internally at Facebook, if you were to go look at like the bulls and the bears on degree of ad monetization, you know, forget about 10 years into the future, but like, let's say even 5 years into the future. So meaning 2017, as of 2012, my guess is would have been a 10x discrepancy between the bulls and the bears on monetization per DAU. And I think basically that's what we're talking about here. But obviously it's not DAU and ad units. What we're talking about here is how much MEV flows to the L1 versus the other things up the stack. A lot of people yell at me on Twitter being like, the apps are going to internalize all the MEV. And like that, I'm just not worried. I mean, you need the validator, to the discussion we had a few minutes ago, you need the validators on board. And if you don't pay them anything, like this shit's not going to work right. And you know, my guess, like I think generically the answer is somewhere between 10 and 30%. That seems like a pretty reasonable bound to me. Arguing sub 10%, my guess is it's just not going to be sustainable. So, in north of 30s, almost certainly too extractive. So like that's kind of like, obviously it's not an analogy, it's just a helpful framework to think about like what that discussion would have been. And here, obviously, I'm not telling you that like Facebook's monetization has any way to do with MEV capture and apps. Like those are obviously completely unrelated concepts. But that would have been the debate to have. So that's comment A as it pertains to kind of the question. And then comment B is like, TAMs always increase. And they like tend to increase as a function of like multiple underlying vectors of compounding. The obvious ones for asset ledgers are more assets. And that doesn't just mean like Apple and Google and Tesla. That means meme coins and more DePIN tokens and more whatever else, like and NFTs, and I don't know what else people are going to come up with. But that stuff's going to keep on coming out. And then as more stable coins come out, there's going to be more FX pairs. There's going to be more of that stuff. And I look at like NASDAQ today or NYSE or whatever, or Euronext, and I'm like, guys, like what these guys are capturing is such a small sliver of what's out there. Obviously, once you start bringing commodities on chain, like just you keep growing the TAM here and have all of these things interplay. And then obviously, like the whole point of these systems is like direct to consumer access. My guess is today, like only on the order of 500 million people in the world have meaningful exposure to like liquid financial like investment assets, and 7.5 billion people do not. Maybe 7 billion. Like maybe I'm being a little too conservative. And just like cool, crypto rails seem like the probable path that most of those people end up becoming investors, both as a function of like the access to the rails and as a function of the unregulated information markets. And so like people learn about investment assets in Thailand and in Vietnam and in Argentina and whatever the fuck from TikTok and from Instagram. And it's like random YouTubers and shit making these random fucking videos about tokens. And they're not making these, I can tell you, they're not making videos about Apple because Apple's not exciting. Tim Cook is boring because his job is to be boring. Like, and so I think the TAM expansion like is just vastly, vastly larger than people think. And then the other kind of element of TAM expansion is like the incorporation of leverage into all of these systems. Again, today, JP Morgan captures that and Goldman Sachs captures that in offering prime services to hedge funds. Interactive Brokers captures it to a very small extent by offering it to like retail, like prosumers, but like large scale leverage available to like random guy in Vietnam has like not been a thing until the last couple of years, basically because of DeFi. And again, like there's, I think 10 years from now, there's on the order at least 100 million people who are like trading with leverage on these systems. And that's just 100% normalized in that state of the world. So, that the TAM expansion that leverage brings, both in terms of trading volumes, risk management, liquidation funds, like all of the obviously other elements that come with managing leverage. All of this stuff is good for the apps like Drift and others, but then also like some of it will bleed down to the L1 or L2.
Okay, actually, I said that was my last question, but you reminded me of one other question. So let's start with your assumption that the marginal cost of software goes to zero, which I would agree with. How does this apply then to the app layer? And where do you think, we sort of talked about order flow. So that's one very obvious example. Where do you think the biggest moats are? If we're like, I guess what I'm saying is we can sit here and agree, okay, look, like the cost to update a ledger is 1/4 of a penny. And I tend to agree with that. I mean, we get Ethereum people disagreeing with that, right? But that is likely the future. Now, in terms of applications, this same logic should apply. Now, applications probably can build moats, but I'm curious to see where you think those moats are. And like I said, like order flow is obviously an example of one clear moat. Like where do you see going forward moats, specifically with regards to apps? And then like maybe eventually, assuming we get some type of like regulatory clarity, like where the value kind of accrues then in what type of apps?
So we have a blog post we wrote a few years ago called Protocols Don't Capture Value, DAOs Manage Risk. In hindsight, the title was misnamed. It should have been DeFi Protocols Don't Capture Value, DeFi DAOs Manage Risk. In fact, I'll probably just tell our team to update the fucking name after the fact. But like, yeah, dude, like Uniswap is 4 years old and like there's no fee on the token, and like that tells you everything you need to know. So systems that manage leverage can always capture fees because you need to have an insurance fund, and like you got to deal with all that. Someone has to govern it and like set the risk parameters, and therefore that someone is implicitly backstopping the system somehow. And so like they need to be compensated for that fact. And like if there's leverage involved, so anyways, so that like is clear as a function of basically like leverage. For spot trading, I think the answer is there is absolutely no margin to be had. At the protocol layer, customer acquisition is customer acquisition, and like convincing random retail people to download your app and use it. If you can convince them to pay 30 bips or 80 bips or 500 bips, like good for you. Like you've earned that right. There's nothing deterministic about customer acquisition. Customer acquisition is inherently like just entropy in the world, in the space. But with DeFi protocols, if you introduce arbitrary fees that can be forked out, then like they'll be forked out, and aggregators will always aggregate around those. Yeah. So the one word answer to your question is or sources of order flow or wallets or front, whatever you want to call them. And that could be true whether the app is parcel, which is like very bespoke and specific to like this niche real estate thing, or it could be Phantom, or it could be Jupiter, or it could be Drift, or whatever. Any of these things, but anything that controls order flow can command a price.
All right. Well, we've now gone for quite a while, and I appreciate your time. I thought it was really good. So thanks for coming on.
Hey, man, thanks for having me on. This was great. Super fun.